Two legendary investors are screaming opposite things about AI stocks right now. One says it's the biggest secular trend of the decade. The other says the earnings you're reading are inflated by an accounting sleight of hand. And you know what? Perhaps both of them are right. Look, if you're short on time or you don't trust some random guy on the internet hiding his face talking about stocks, here's what matters. There's no doubt that companies like Alphabet, Meta, and Oracle are extending the useful lives of their AI servers on paper, from what it used to be 2 to 3 years out to 5 or 6 years. That move alone reduces their depreciation expense by billions, and makes their earnings look way better than the economic reality. If you own these stocks or you're thinking about buying them, you need to value them on free cash flow after capital expenditures, not on reported net income. That's it. That's the whole thing. But if you want to know more, perhaps stick around. I'm going to explain it in about 10 minutes. Alright, for those of you who are new here, hey, I'm DataCat. I used to be an analyst buried inside a Fortune 50 company. You know, the kind of place where you spend half your day in meetings that could have been emails and the other half building models that executives ignore. I traded that whole corporate grind a few months ago for, well, this, lasers, mechanical keyboards, and trying my best to explain finance without putting you to sleep. This channel is only about 3 or 4 months old now, so we're still figuring things out together. So your support would mean a lot to this channel. That like and subscribe button would keep me motivated. I'm not here to brag or, sell you some courses or trying to pump some penny stocks. I mean, even I tried to. A small channel like this literally can't pump anything. But instead, I make cat jokes. Cats are gentle creatures. Until they knock your water glass off the table just to watch you panic. Kind of like the market, honestly. Alright, enough with that. Let's get back to the story today. So we got Michael Burry again, who keeps being discussed on social media recently, not only because of his put position on Palantir and Nvidia, but because he is actually doubling down and says most of the popular AI stocks are overvalued. Not that AI is fake or demand doesn't exist, but because, in his words, the earnings are flattered by accounting gimmicks. Specifically, he estimates that hyperscalers are understating depreciation by around $176 billion between 2026 and 2028. He's saying Meta could be overstating earnings by 21% and Oracle by 27% by 2028. On the other side, you've got Tom Lee from Fundstrat, who's been one of the most bullish voices on Wall Street for years now, and he's saying AI is a structural multi-year cycle. He's talking about scale economies, network effects, and capital rotating into this space faster than almost anything we've seen. Now here's the thing. When I first read both takes, my initial reaction was, okay, one of these guys is wrong. But the more I dug into this matter, I realized they're actually both describing the same elephant from different angles. And if you understand both perspectives, you can actually position yourself better than 90% of retail investors who only read headlines. So let's start with Tom Lee's side. Demand for AI infrastructure is absolutely real. Capital is not fleeing this space, it's rotating within it. And there's this perfect example that just came up. SoftBank sold its entire Nvidia stake. We're talking about 32.1 million shares worth roughly $6 billion. That's a massive exit, right? The stock dipped about 2% on the news. Some headlines screamed, SoftBank dumps Nvidia, is AI over? But here's what actually happened. SoftBank's management came out and said, we're not bearish on Nvidia, we sold to bankroll other AI bets. Where'd the money go? Straight into OpenAI. They didn't leave AI, they just moved upstream from the chipmaker to the model company. And that's it. That's a critical distinction. When you see big allocators like SoftBank, sovereign wealth funds, pension funds, when they're selling one AI name to buy another AI name, that tells you the capital expenditure supercycle is intact. They're not rotating into bonds or gold or cash, they're rotating within the AI stack. Now, let's hear what Tom Lee actually says.
Don't you have any concern at all about the level of money that these companies are spending on their build out, and now the new wrinkle of tapping the debt market rather substantially to help do it?
I mean, Scott, yes and no. I mean, AI is proving to be a scale game. It's not like you and I could start a garage and make a model competitive with OpenAI. We need to have scale and a lot of chips.
In simple terms, you just can't build foundational models in your garage. You need tens of billions of dollars, you need chip supply agreements, you need data center footprints. That creates massive barriers to entry. And it supports Tom's thesis that the leaders in computing platforms, Nvidia, Microsoft, Google, Amazon, should compound through this cycle. But then, here's where Burry walks into the room and knocks over your coffee mug. Because even though demand is real, the reported earnings you're seeing from some of these hyperscalers are, let's say optimistic. When a company buys a server or an AI accelerator, like an H100 GPU from Nvidia, they capitalize that cost. They don't expense it all at once. Instead, they depreciate it over its useful life. If you think that server will last 5 years, you spread the cost over 5 years. Simple enough. But here's the trick. Normally speaking, or by conventional norms, these AI chips are getting replaced every 2 to 3 years in high utilization environments. The technology cycle is fast. A chip that's cutting edge today is economically obsolete in 30 months because the next generation is twice as fast and more power efficient. That's the reality on the ground. Yet what are companies doing on their books? They're extending the useful lives to 5, even 6 years. In fact, Alphabet was already doing so back in 2023. They moved their server and network equipment useful lives out to 6 years, and they disclosed right there in the footnotes that this change reduced depreciation expense and boosted net income by multiple billions of dollars. And Meta, Oracle, others, they've done similar reassessments. They're hard evidence of this. Burry's not making it up. The numbers are in the filings. An average financial analyst would have noticed it. I personally think that everyone just avoid talking about it. But since we've already brought this up, what does it actually mean for us as investor? Well, it means the net income line, the earnings per share figure, the operating margin, they're all flattered. The cash going out the door for capex is real. The economic wear and tear on those assets is real. But the accounting expense is artificially low. It's like if you bought a car that only lasts 3 years, but you told your accountant, let's depreciate it over 6 years to make my profit and loss statement look better. Sure, your income statement looks great, but in 3 years you're buying another car and the cash is gone. Now, product cycles in AI hardware are fast, but the economic moats are real. Yes, GPUs get replaced quickly. Yes, that creates a risk that depreciation doesn't match economic reality. But there's also counterbalance. Remember that Nvidia isn't just selling chips, they're selling CUDA, the software stack, the compiler ecosystem, and the developer tools. Once you build your infrastructure around CUDA, switching to AMD or Intel or anyone else is expensive and risky. That's lock-in. That's pricing power. So even though there will be periods where hyperscalers digest their capex, maybe they pause orders for 2 quarters, maybe they negotiate harder on price, long-term, the leaders with intellectual property, software ecosystems, and proprietary supply chains should compound. Tom Lee's been saying this for months. The structural trend is intact. You're going to see bumps, but the winners keep winning. And on top of that,
leads us down. But the second, it really highlights the grim reality that we're about to have a third year of double-digit gains. The S&P's up 80% over the past 3 years, and funds are measured on 3-year performance. Only 21% of fund managers are beating 80% over that 3-year period. It is one of the worst ever periods for fund managers, and so they'd rather see the market fall so that it falls to their performance level. I think what's more likely, of course, is the market follows a seasonal pattern, which means there's going to be a lot of chasing into year end.
In fact, from a technical perspective, that's an interesting point. A lot of professional investors are underweight this rally because they missed it early, and now they're just hoping for a pullback so they can feel better about their performance. But remember, hope is not a strategy. Alright, let's get specific. What does all this mean for the actual stocks you might own or be looking at? Structurally, Nvidia is clearly a winner. The ecosystem moat is real. SoftBank's exit was a reallocation, not a fundamental indictment. But watch for cyclical air pockets. If Microsoft or Google or Meta pause orders for a quarter or two to digest capacity, Nvidia's revenue can wobble. That's not a reason to panic, it's a reason to pay attention to customer concentration. What product transition cadence and supply chain scaling? Meta's AI spend is huge. They're using it for feed ranking, ad targeting, content moderation, all high ROI applications. But remember the depreciation issue. If they eventually shorten useful lives or if the capex mix shifts toward higher churn accelerators, reported margins could reset lower. Don't value Meta on inflated earnings. Value it on free cash flow after capital expenditures. Then about Oracle. Burry flags Oracle as having the largest potential earnings overstatement, 27% by 2028. That's massive. If you own Oracle, you need to scrutinize their depreciation policies, their CapEx productivity, and their long-term cloud margin trajectory as AI workloads scale. This doesn't mean Oracle is uninvestable. It means you need to be conservative in your valuation. And Palantir, which is an application layer player. They're benefiting from AI hype, and there's some genuine product traction. But Tom Lee himself has said some of these names are in price discovery mode, meaning the multiples are ahead of the fundamentals. Underwrite Palantir on contract quality, government versus commercial mix, cohort retention, and true AI-driven margin lift. Not on narrative, not on vibes. So what do we watch for? I'm seeing 3 scenarios. First, the bull case where AI monetization visibly scales. Hyperscalers maintain spend. Compute leaders hold pricing power through product cycles. Depreciation policies stay stable, free cash flow converts. Keep your eyes close on rising AI revenue disclosures, improving incremental margins excluding depreciation, multi-year supply agreements being signed and extended. Then the base case. The continued high spend, but with digestion periods. Secular growth continues, but at a steadier pace. Some multiple compression as investors demand cash returns instead of just growth promises. Reported margins normalize as depreciation and mix shift catch up with reality. And of course, let's also talk about the bear case, the monetization lags, which by the way I'm not seeing any at the moment. Companies pause or cut capex. Some hyperscalers shorten useful lives or even impair assets, which would crater reported earnings and margins. Watch for any negative ROI disclosures, policy reversals on useful lives, capex cuts with weak AI revenue KPIs. Right now, we're somewhere between bull and base. Demand is strong, but you're starting to see some companies like Google getting asked on earnings calls, when do we see the revenue payoff from all this AI spend? That's a healthy question. It keeps management honest. Okay, so what do you actually do with all this? First, stay overweight durable moats in compute and platforms. Nvidia, Microsoft, Amazon Web Services, Google Cloud, these are leaders with scale, ecosystems, and capital to sustain multi-year build-outs. But, and this is crucial, value them on cash returns and normalized economics, not inflated GAAP EBIT. In simple terms, if a company is reporting 30% operating margins, but half of that is because they extended depreciation lives, that margin is fake. Look at free cash flow. Look at capex as a percentage of revenue. Look at maintenance capex versus growth capex. Second, be neutral to cautious on names where earnings quality is heavily dependent on extended useful lives and AI monetization proof points are sparse. If a company is spending billions on AI infrastructure but can't show you incremental revenue or margin expansion, that's a red flag. Third, expect to trade the cycle. There will be windows where capex digests, where orders pause, where stocks pull back 10, 15, 20%. Those can be buying opportunities if the fundamentals are intact, but you have to know what you own and why you own it. Alright, let's bring it home. Tom Lee's secular AI case is intact. Capital keeps rotating into AI. SoftBank didn't dump Nvidia because AI is over. They dumped it to buy OpenAI. Core suppliers and scaled platforms should compound over the next several years. Michael Burry's accounting critique is also valid. Useful life extensions are real and material to reported margins. Alphabet's disclosures back in 2023 already proved it. Broader industry changes already confirm it. Both perspectives are useful. Neither is complete on its own. If you understand both, you can position yourself better than most investors who only read the headlines. Look, I'm not going to tell you what to buy or sell today. I'm just some guy who used to build models in a cubicle and now does it in front of a camera. But I will say this, the AI cycle is real, the accounting games are real, and the opportunity is real, only if you know what to look for. If you found this helpful, maybe hit the like button. Subscribe if you want more of this kind of analysis. I'm still figuring out this whole YouTube thing, so your support actually means a lot. Alright, that's it for today. DataCat out. Stay curious, stay skeptical, and don't let your investments knock your financial goals off the table. I'll see you in the next one.